Have you ever noticed something strange? The average person invests in stocks, maybe some ETFs, maybe real estate, but wealthy people, they play a completely different game. They don't chase trends. They don't panic during crashes. And they definitely don't invest the way social media tells you to. Today, I'm going to break down exactly how wealthy people invest differently, and more importantly, how you can apply the same principles starting today. This isn't about get rich quick. This is about understanding the rules of a different game. Let's get into it. 1. They invest in cash flow first, appreciation second. Most people invest hoping something goes up in price. Wealthy people invest to get paid. That's a huge difference. The average investor asks, will this stock go up? The wealthy investor asks, how much cash will this produce? They prioritize rental income, dividends, private business distributions, royalties, and cash-flowing assets. Appreciation is a bonus. Why? Because cash flow reduces risk. If the asset drops in value temporarily, they're still getting paid. Investor tip: before buying anything, ask, does this produce income, or am I just hoping to sell it to someone else for more? 2. They use leverage strategically, not emotionally. Most people are afraid of debt. Wealthy people understand debt. But here's the key difference. They use debt to buy assets, not liabilities. Average debt: car loans, credit cards, consumer spending. Wealthy debt: rental properties, businesses, and cash-flowing investments. They borrow at low rates to acquire assets that generate higher returns. That spread builds wealth. But notice something important. They calculate risk carefully. They don't over-leverage. They keep reserves. They stress-test deals. Investor tip: if you use leverage, ask, if revenue drops 30%, can I still survive? 3. They invest in private markets. The average person invests only in public markets, stocks, ETFs, mutual funds. Wealthy investors, they invest in private deals. Examples: private equity, private credit, real estate syndications, startups, owning businesses. Why? Because private investments can offer higher returns, provide tax advantages, be less correlated with public markets. Public markets are accessible to everyone. Private markets reward access, relationships, and due diligence. Investor tip: if you're not accredited yet, start learning how private deals work. Understand deal structures, risk, and cash flow mechanics. Even if you're investing in public markets today, think like a private owner. 4. They obsess over tax efficiency. Here's something most people ignore. It's not what you earn, it's what you keep. Wealthy investors structure everything around tax efficiency. They use depreciation, real estate write-offs, business deductions, tax-advantaged accounts, trust structures. The average investor focuses on returns. The wealthy investor focuses on after-tax returns. A 10% return taxed heavily might be worse than a 7% tax-efficient return. Investor tip: before chasing higher returns, ask, can I structure this better? Sometimes the biggest gains come from reducing tax drag. 5. They diversify across asset classes, not just stocks. Most people think diversification means owning 20 different stocks. Wealthy investors diversify differently. They spread across public equities, real estate, private businesses, fixed income, alternatives, sometimes even art or commodities. Why? Because different assets perform well at different times. When stocks fall, maybe real estate holds. When real estate slows, maybe private credit performs. Diversification reduces volatility, and lower volatility protects compounding. 6. They think in decades, not months. The average investor checks their portfolio daily. The wealthy investor thinks in 10-20-year time horizons. They understand compounding is exponential. And exponential growth looks boring at first. They don't panic sell. They don't chase hype. They don't jump in and out constantly. They focus quality, durability, long-term trends. 7. They invest in themselves first. This is the most important difference. Before building portfolios, they build skills. The highest ROI investment, your earning ability. Wealthy individuals often build businesses, develop rare skills, increase income dramatically, because more income equals more capital to deploy. Investing $1,000 wisely is good. Increasing your income by $100,000 per year, that changes everything. Investor tip: your first asset is your skill set. Grow that aggressively. Here's the big takeaway. Wealthy people don't invest differently because they're lucky. They invest differently because they think differently. They focus on cash flow, tax efficiency, ownership, time horizon, asset allocation, and skill development. If you found this valuable, subscribe for more in-depth investing strategies. See you in the next video.